Hey folks, welcome to verifiedinvesting.com. My name is Gareth Soloway, Chief Market Strategist here. Now, in today's video, we need to dive into what happened overnight with the Japanese stock market. Ultimately, their 10-year yield began to push up, and their stock market intraday collapsed 2.5% before recovering just a bit. But the point is that what you're seeing in Japan is a looking glass into the future of the United States. All right, let's take a look here and see what's going on. This is the Japanese stock market, the Japan 225 index. And what we could see is that everything was going pretty normally, right? All of a sudden, we started to see a collapse here in the Japanese stock market. Now, it collapsed 2.5% from peak to trough. It did recover a little bit by the end of the day. If we look at it on the daily chart, you can see that, again, it ended down 1.29% or so. So it was down about 1.3%. But ultimately, notice the chart. Vertical to the upside, very similar to what the United States' stock market has done recently. But again, the difference maker is their 10-year yield is pushing up. Now, keep in mind, folks, is that we've been in a period here. Now, for the last 3 days, we've seen the Fed cut rates, right? The Fed cut rates at their last meeting, 25 basis points. And every day since, the 10-year yield in the United States has gone higher. That's contrary to what a lot of people would assume. But what we have to remember is the central bank here, the Federal Reserve, does not control the long end. They only control the short end. So they can control the 3-month, these type of very short-term lending rates, but the longer-term rates, the 10-year, the 20-year, the 30-year, the market controls those. And we're seeing that in Japan because Japan's central bank has set their interest rates very, very low and did not raise them, yet their interest rate on the 10-year continues to make major highs. So let's dive back into it and take a look. This is the 10-year yield in Japan, the Japan government bond 10-year yield. And what we see, look at this move right here. So it wasn't even that dramatic of a move, but it was just enough to trigger panic for a short period of time in the Japanese stock market, in the Nikkei. And ultimately, again, when I look at this technical chart, and you guys know I'm all about charts and data, this is a very bullish chart. Okay, very much flattish to slight incline with a steeper rise underneath. This is what we would call a bullish wedge pattern. And this pattern tends to break to the upside. And what that tells me is that if that pattern does come to fruition, the Japanese stock market, the Nikkei, is going to see more downside in the near term as the 10-year yield there spikes higher. And like I said, folks, we have to wonder. And by the way, look, if I zoom out, look at this. I mean, look at the run that the 10-year yield in Japan has had. Incredible. Now, we have to keep in mind, well, why is this happening in Japan, right? Well, the essence of it is simply you look at debt to GDP. Debt to GDP in Japan, right here, 236.7% debt to GDP. That is insane, folks. That is an epic amount of debt to GDP. Now, if you go over to the US is less, but it's still a scary number, 124.3% debt to GDP. And so the point being is that ultimately, we as a country in the US, we're looking at Japan as what will likely happen here in the United States. In other words, Japan is just further along in the projection or in the model than the United States is. But at our current rate, we will catch up very, very quickly, and it is unsustainable. And it's one of the reasons why it's so important for me to stress the U.S. getting their debt situation under control, and so frustrating to me and many of us when the U.S. passes bills that just increase spending with a very short-term eye on essentially fixing the issue, right? If you look at politicians, doesn't matter which side of the aisle, they all want to get reelected, right? And this is one of the issues, is that when you focus on reelection, it's every 4 years, maybe every 6 years, whatever it may be. But the point is that their goal is to keep things really good for the next 4 years, because then they get reelected. But in essence, when you make things good in the short term, what do? You sacrifice the long-term good, the health of the body, of the country. And we've seen this go on and on and on, right? And ultimately, again, when you have debt to GDP getting way out of control, there are going to be things that eventually break. The question is when. How far can the can be kicked down the road? Now, if we go back to the charts again, 124.3% debt to GDP is not good. Now, granted, does it still mean that we might have a little bit of a runway? Yes. But the other thing you want to keep in mind is you want to keep in mind that the overall global debt to GDP, which is essentially at all-time highs. And so I don't think the US has as much of a runway as Japan, because the essence is, if you look at the whole world, debt to GDP is skyrocketing across the board. And so eventually, when you have the whole body, the whole world jumping up in debt to GDP, it means the US doesn't have the luxury of getting to where Japan is at 236.7% of GDP. Maybe we get to 160%, maybe 170%, but at some point we start to see a break. So again, the Nikkei, we look at the Nikkei. Let's go to the bigger chart pattern. Vertical since April 2025, since the Liberation Day lows. Look at this. If we look at the directional move on the Nikkei again is now up 49% off of those lows. If we look at the S&P 500 and we go out here, and I have my other trend lines on, but if we look from the April low here, the S&P is now up 37% in a vertical line. All right, the 10-year yield on the US. Now, there was a key trend line break here, right here. We broke it, but look, since this is the day the Fed cut rates, since then, look at yields spiking higher. We're now at 4.145%. Now, again, yields are a lot different here in the US on the 10-year than in Japan, where they're literally at multi-year highs. But the point being, again, is, are we looking into the future? Even if the Fed cuts rates, by the way, Japan's central bank basically has had zero interest rates. They even had negative interest rates. And look at their yield. So the point being is, if that's happening to Japan, it doesn't matter how low the Fed cuts the rates on their Fed funds rate. Ultimately, we can still see the 10-year go up, up, and away. And if that happens, things break very easily. And we just saw, I repeat, in the Nikkei, in the overnight, when you see this type of drop, this is just the warning shot. This is the warning shot across the bow of the overall market and the world of rising debt to GDP and interest rates on the long end. And again, you get interest rates on the long end to keep going up, doesn't matter where you are. Things are going to break because we have a society, a world that is leveraged to the hilt, and it requires low interest rates. It does. And when you get the market and the market starts saying, no, these countries, no chance of them ever getting their debt under control, what does that mean? It means things begin to break, and you can't have things at all-time highs. So listen, it doesn't necessarily mean that the S&P is on the verge of a collapse, but we need to monitor the yields. The yields now, to me, are probably the most important thing. The 10-year yield pushing up here. Let's see what happens in the near term. The Japanese 10-year. Does it break out of this wedge pattern and make a spike higher? Because if this starts to happen, you will see a break in the stock markets. Globally, it'll start in Japan like we saw with a down move. And if it continues in Japan, you guys know what's going to happen. It's going to spread like a wildfire. And we have to be ready for that. So just a heads up, monitor this. And I always try to bring you guys things that you might not be watching. Like, in all fairness, I would garner that 99% of everyone watching this video probably didn't know about the Japanese stock market falling and the 10-year yield spiking there overnight. But again, my job is to keep an eye on every nuance and try to see what is the key factors. What's the data telling us? What's the risk involved? We can all live with our head in the sand and just say, oh, the markets will go up forever. Okay. And then you know what happens? 08, 09. And people lose their retirement accounts. I saw it happen. I was trading through it, folks. It was nasty. People had to go back to work. They retired, they lost all their money or majority, and they had to go back to work. My goal is to never let that happen to anyone that follows me, at least. All right, doesn't mean it won't, but I'm going to do my best to curb those risks and make you aware of those risks so that we can avoid that catastrophe. Doesn't mean we won't take losses. I take losses all the time. Is it manageable? Yes. Get right back on the horse, start making money. But you don't want to let the drawdowns, the epic drawdowns occur. That's the key. All right, watch the Japanese 10-year, watch their stock market, watch the US 10-year. This is now the most important thing in the markets. You guys have a great one. Thanks so much for tuning in. Thank you guys for supporting me and supporting Verified Investing. Take care.